The stock market has taken a significant hit recently, with major indices experiencing their worst declines in years. Investors are left questioning, is this the time to buy the dip, or are we on the brink of a prolonged bear market? In this video, we'll analyze the current market conditions, examine statements from the Trump administration, and explore key indicators to help you navigate these turbulent times. This is The Alternative Investor. Let's dive in. Welcome back to The Alternative Investor, your go-to source for insightful market analysis, investment strategies, and financial news that cuts through the noise. If you haven't already, like and subscribe to stay updated on the latest market trends and investment opportunities. We value your insights. Share your thoughts in the comments below. Are you buying the dip or staying on the sidelines? Over the past few weeks, the stock market has faced significant volatility. On April 3, 2025, the S&P 500 dropped nearly 5%, marking its worst single-day performance in 5 years. The Dow Jones Industrial Average fell by over 1,600 points, and the Nasdaq Composite plummeted by 6%. These sharp declines were largely triggered by President Trump's announcement of sweeping new tariffs, including a baseline 10% tariff on most imported goods and higher rates for specific regions, such as a 20% tariff on the European Union, 25% on South Korea, and 24% on Japan. These tariffs, dubbed Liberation Day levies, are designed with reciprocal rates tied to the U.S. trade deficit with each country. President Trump addressed concerns over the market reaction, stating, "I think it's going very well. The markets are going to boom, the stock is going to boom, the country is going to boom." Despite the president's optimism, analysts warn that such tariffs could significantly impact corporate earnings and consumer prices, with potential declines of 1 to 2% per 5 percentage point rise in tariffs. Historically, market corrections have often presented lucrative buying opportunities for long-term investors. The strategy of buying the dip involves purchasing stocks at lower prices during market downturns, anticipating a future rebound. Some investors view the current decline as a chance to acquire quality stocks at discounted prices. For instance, Thorne Perkin, president at Papamarku Wellner Perkin, believes the recent sell-off has been overly severe and maintains optimism about U.S. stocks. However, it's crucial to consider whether the factors driving the current downturn, such as escalating trade tensions and potential earnings declines, are short-term hurdles, or indicative of deeper, more prolonged issues. Conversely, several indicators suggest that the market may not have reached its bottom yet. The Nasdaq Composite is on the brink of entering bear market territory, defined as a decline of 20% from a recent peak. Additionally, the S&P 500 has fallen by 12% from its February highs. Analysts point out that typical signs of market capitulation, such as spikes in the SIBO volatility index, elevated put-to-call ratios, and extreme declines in market breadth, have not yet fully materialized. The VIX remains below levels observed in past corrections, suggesting that investor fear hasn't peaked. Moreover, the recent tariffs have intensified market uncertainty, discouraging buyers and raising the risk of a trade war, which continues to weigh heavily on investor sentiment. Market experts are divided on the current situation. Some, like Michael Farr, suggest that the drop presents a buying opportunity, while others warn that markets have yet to fully price in worst-case scenarios, including recession and stagflation. Notably, major investment firms like UBS and RBC have revised their 2025 S&P 500 targets downward, with UBS now projecting 5,800 and RBC 5,550. JP Morgan estimates a 60% chance of a global recession if tariffs persist. These mixed signals underscore the complexity of the current market environment and the importance of a cautious, well-informed approach. Given the prevailing uncertainties, investors might consider the following strategies: diversification, spread investments across various asset classes and sectors to mitigate risk. Focus on fundamentals. Prioritize companies with strong balance sheets, consistent earnings, and competitive advantages. gradual investment approach. Instead of making large investments all at once, consider dollar-cost averaging to reduce the impact of volatility. Stay informed. Keep abreast of policy changes, economic indicators, and market trends to make timely and informed decisions. Navigating market volatility requires a balanced approach, blending caution with opportunism. While buying the dip has proven effective in past corrections, it's essential to assess the unique factors at play in the current downturn. We'd love to hear your perspective. Are you viewing this as a buying opportunity, or are you bracing for further declines? Share your thoughts in the comments below. Don't forget to like and subscribe to The Alternative Investor for more in-depth analyses and strategies to help you thrive in any market environment. Stay informed, stay strategic, and as always, happy investing.